We should be going live here in probably about 10 or 15 seconds. At least that's what it says. So we'll try to refresh that and hopefully we'll be going live here. And so we are live 7 seconds in. So Sam, great to see you tonight on St. Patty's Day. Last week, I think we were 20 minutes late getting on, or maybe 10 minutes late. Today, we're about 2 minutes late getting on. I had a few technical difficulties. It's interesting because Facebook changes the way they interface with Zoom. And so that's what's happened. And we're having a few glitches trying to get that figured out. They've actually made it easier, quite frankly. And so once again, this is Pip and Sam on the wealth debate. I believe this is our 14th or 15th wealth debate. I think it's 14. And so if you are on the chat, like I ask every time, I'd really like you guys to jump in, say hello, and I'm going to reply to you guys. So if you're on there, please say hello. Let us know you're there. If you have any questions, any topics you want us to talk about, we will definitely do that. And so please let us know you're there. And I'm going to turn it over to the guy dressed in St. Patty's Day green, Mr. Sam Musa, for the next 45-minute rant.
No, not 45 minutes.
How you doing, Sam?
I'm doing good. Just looking at income rates in Canada and in the US. Average income rate in the US. Let's see. Just want to write this. So 2019, because last census was done. So let's do 2020. Okay, so the average U.S. household income is $87,000. The median income is $61,000. Median being the middle amount. So there's an equal number of people below it and an equal number above it. That's what median is. That's why we use median household prices, house prices, because that means there's 50% below and 50% above. And that's the middle number, right? That's the middle number. So even though your average income could be $87,200 in the US, just over 87,000, that could be skewed because of a lot of people having a lot of money on the upper end, dragging the number up. But it's a small percentage of people relative to the whole population, so it drags it. So you can't always use average. Median is a better number, yeah.
Was that US or Canada that you're using?
That's US.
Okay, so then it's like 700,000 Canadian dollars.
At least
84,000 US. Just checking. Okay, just making sure.
At least. So let's see here. And in Canada, I'll give you a reason why we're doing this in a second.
It's okay. The suspense is killing me too, folks.
So, which means, okay, so average in Canada, I don't want the average salary. Well, I guess 55,000 is what it says. That's individual, but I'd rather see the median income. Give me 1 second. Median income. The reason I'm doing this is because, come on.
The reason you're doing this is you should have done it before we got on here.
Yeah, I know, but I was just in the middle of it. You were supposed to talk longer, Pip.
Oh, well, I can talk for days. That's never an issue. Well, the interesting thing, and I think you're probably going to get pretty close. If you average two of those salaries together, 55, you're going to be up about 100,000, let's say, which ends up being about $80,000 American. So 84 American, 80,000 Canadian. I mean, if we do it that way with the exchange rate, we're right at about the same amount. A little bit more maybe in the Canadian market than the US market is my guess. So
it says that the average Canadian salary in 2020 was $1,000 per week for employees across the country. So 54,600, 54,000, but that's still average. Anyways, why am I bringing this up? This is why. So the Fed today decided to tell everybody they got good news. They're going to keep rates low. They anticipate unemployment is going to rise, and the GDP is going to be a huge improvement from last year, which is a shock considering there was basically no GDP, right? So, and employment is going to increase. They're good that, something similar, 6.4, 6.5. It's going to come down to their goal, is to bring it down to 4%, which is considered full employment. So how are they going to do this? They're going to keep rates near zero. They're going to keep buying their bond program. They're going to try to increase the money supply and keep doing that. And for the foreseeable future, the Fed is going to try to prop up the economy by flooding flooding money into the pool, the money supply in the United States. Canada's similar approach, not as aggressive, right? But the U.S. is the idea is if they keep pushing money into the economy, yes, there'll be a huge money supply, very little GDP, but they're hoping that the GDP will catch up, and the GDP, there'll actually be growth. If they just keep the system going, it'll go. Now, while you're doing this, you're going to see asset prices rise, like real estate is going to continue to rise, stock market's going to continue to rise, producing smaller and smaller yields, right? The returns they're going to get from actual yield, right? Cash flow or dividends is going to be smaller and smaller and smaller, because the more you pay for an asset, right, the less the income relative to that asset value, it gives you a decent return. So your returns, say, go from 5% or 6%, say, and they go down to 5, then 4, then 3, because the cost is so much higher now to produce that yield. Capital growth, on the other hand, is going to continue to rise. So real estate prices will continue to rise, stock market will continue to rise, because there's the increased money supply is creating floods of money going into these two asset classes. Now, here's the dilemma that I want you to contemplate and understand why this becomes a problem long term. It becomes a problem long term because and let's look at property. So let's say that you've been qualified for a mortgage, and your mortgage. Let's look at Pip. Maybe you can help me out here. We'll use the United States. So what's the interest rate right now for the 30-year? Roughly?
I will have to, I don't off the top of my head. It just went up.
We're going to look at the 30-year mortgage, right? And we're going to say that this Joe America
2.5.
What is it, sorry?
2.5.
2.5. So if the interest rates are 2.5, and let's say that this average American Joe can afford a $2,000 maximum mortgage payment. So how much can he afford if he puts 5% down? So how much house can he buy? What's the maximum cost? So let's go to 2.5. I'll tell you. So 2.5, he or she can afford basically a property at 520,000 if they put 5% down. Now that's if they can afford a $2,000 mortgage payment. Now stay with me here. So you can afford $2,000. Now, let's say interest rates go down a full point. So let's go from, let's go in reverse so we can understand where we are now. This is kind of where we are now. But say 2 years ago, say the mortgage rates were closer to, say, 3.5. Now, if they're 3.5, that same American with $2,000 can afford a $460,000 property, 30-year mortgage, 460. That's fixed, by the way. So 30-year, $460,000 house. Now, when they drop the interest rates to 1.5, that same person can now afford, like we said, $520,000. So the property value of what they can afford is $520,000 value. Okay. Now, the increase from the previous property was how much, Pip? How much did we say they could afford before?
I don't remember what you said. Sorry, I was
Stay with me,
taking a nap.
Stay with me, Pip.
I was taking a nap over here.
460,000. Everybody write that down. 460K. This is important. So they dropped the interest rates to 2.5. Now that same person can afford a $520,000 property. Okay?
Gotcha.
So 60K. So it's gone up from 460 to 520. What's the appreciation rate? How do we get that? We get our calculator out and we say, okay, if it's 460,000 and now it's 520,000, 60,000 was the increase on that property.
11%, roughly 11%.
Okay, so 11% it's gone up in 1 year. Now, how did it go up 11% in 1 year? Well, I mean, if you drop the interest rates, that same house, now that only could be priced at, say, 460,000, that same house can be priced at 520. Why? Because that person that could only afford a lower cost house now can afford this higher cost house because the interest rate dropped. Okay, so 11%. It's gone up 11%. Okay. Now this is what effectively the Fed's done in Canada and the U.S. Bank of Canada by dropping the interest rates. So the house values have gone up, not because the house is actually worth more. It's because I can spend more on my house with the same income at $2,000 because the interest rates have gone down. The interest rates have gone down. Okay. So let's go down even further. Let's go to 2%. If it goes 2%, now that house value can go to, now it can go to 560. It's gone up another $40,000. And then we go a little bit lower and we go to 1.5. That same house now can go up to $620,000. You see what's happening? So the interest rate keeps dropping. That same $2,000 now that you can afford per month, right? Because your income hasn't moved. Your income actually hasn't grown, right? It's the same $2,000. You can afford to pay more for that same house. So this is really what's happening with real estate. So because they dropped the interest rates, you can afford to buy or pay more, right, for a house. Same house though, you can pay for because you're paying less in interest. Now here's the problem. Here's the problem. What's going to happen to house prices when you say get to 1.5%? Say the mortgage rate's 1.5%, right? What are you supposed to do now? Like in Canada, we're hovering just above that. What are you supposed to do now? If incomes don't move or move at say 1%, your income goes up 1%. So think about that. How much more are you going to make if you can afford $2,000 a month? So increase that by 1%. What's 1% of $2,000? 1% of $2,000 is anybody?
You asking me?
Yeah, go ahead. What's
$2,000? Is that $20?
There you go. So $20 times $20 times 100 is $20 is $2,000. So it goes up $20. So $20. What can $20 buy you in the way of more house? So if I made $20 more, it will actually go up a little bit. If I made $20 more, how much more house can I buy? I could buy. Sorry. Yeah, $20 more. I could buy, my house could go up to, I'm going to go back to 2.5 because that's where we were. Okay. I can afford to pay, instead of that original 520, now I can afford looks like 570. So 540, I can afford to pay more on that house on that 30-year term. Okay. So it's gone up a little bit. My income's gone up a little bit, 1%. I can afford a little bit more. But what happens when the interest rates go in reverse, right? Because at some point the interest rates got to come back up, because if you keep going to zero, what happens is if we go to zero, and this happened, and we were talking about this deflation, right? When the money supply is there and people aren't spending because their incomes can't afford to pay the inflated prices, right? They stop spending. So if house prices keep going up 5, 10, 20, 30%, and your income's only going up at 1%, you can't afford to buy that house. Now, so what has to happen? The house price has got to come down to meet the income, right? And just so we're clear, income is most likely going to be flat for the next, I don't know how long, right? I don't know how long. And the Fed knows this. They know this. They're hoping that competition, which is we talked about this in the United States, really what drives prices down, right? Competition drives prices. So your income doesn't need to really go up if your competitiveness in your country pushes prices down. So like for TVs and entertainment stuff. So all those things that we use, the consumables, go down in price because of that aggressive competition, which is awesome, right? That's why you don't need to see a massive income increase year over year, because things get cheaper and cheaper because of that competition. So you can still consume and continue to grow your consumption, right? You can buy more stuff because of competition. The dilemma is when you get into the asset classes of real estate and stock, this becomes a problem. It becomes a problem because if house prices are continuing to rise and my income is only moving up a little bit, right? It's not like competition. Competition is not driving house prices down where I can afford more house because prices come down. Prices are continuing to go up. So normal competition is not pushing that down. So as prices go up, they get to a point where the people who live in that community can no longer afford to buy the houses there. And we see this in places like San Francisco, New York. New York's been hit pretty hard. Vancouver, Toronto, where the people who live there can't afford to buy a house. So the strategies of these banks, more specifically the country's bank, the Bank of Canada or the Federal Reserve or the Bank of the UK, right, the United Kingdom, the Bank of England, they continue to reduce rates. But when you flatten out your rates, the only thing you can do is extend your mortgages, right? Because if I extend the mortgages, I can bring the payments down. That's another way. That's another game we can play, right? Extend the mortgages. If I can make it a 40-year mortgage, all of a sudden they can afford to pay more for the house. But all of these things run out. All of them run out. There's a point where if even zero down payment and 40-year mortgages and interest rates is zero, there's a point where it can't go anywhere without actual considerable growth in your income. And in a competition environment, that's not going to happen. So the Fed's banking that as the United States and the world goes through this transition of working from home, of the internet-based economy, of warehouses, right? Where you're not going to the store anymore. There's just warehouse centers, right, where they're shipping stuff out, right? Nobody needs to go to a place anymore to buy anything. They just order it online, right? This is the shift to this online cocooning, which, by the way, when I was in university, which was a long time ago, they were talking about cocooning, people staying at home, and they used to laugh when we talk about cars coming to your house for you to test drive. Like, you don't even go to the dealership. They bring the cars to you. They're doing that right now. You can do that right now. Like, you don't have to leave your house. So this shift is going to take some time. And what usually happens is there's some destruction of wealth. So those jobs, those higher paying jobs, are going to be destroyed in the hope of new jobs being created, which will happen. This will happen. But the length of time it takes for all of this to happen is the risk area. This is the risk point where the economy is going to be fragile. And if monetary policy is not dead on, right, or close to dead on, this can create severe situations like recessions, hyperinflation, and deflation. So in Japan, went through the lost decade of 91 to 2001 was called the lost decade because they basically had no growth. They had like less than 2% GDP. I think it was 1.5% GDP, no growth. And people started hoarding cash because cash actually was increasing in value. Consumption of what they could do was better than asset, and their housing market collapsed. It collapsed so much so I think land dropped something like 60 or 70% over that decade. Like, it was huge, right? Huge. Housing prices dropped 30-40% over that decade. It was terrible for their economy, and it took them a long time to start turning things around. So one of the things that I can tell you that I think is going to happen with the economy, I can tell you that real estate's going to continue to rise. So is the stock market. And that the Fed, and the reason is the Fed seems committed to this continued, buyback program of bonds, of assets. They're going to continue to buy, and they'll continue probably to expand that balance sheet. They're going to continue to keep interest rates almost at zero, lending rates, short-term lending rates, right, which is going to fuel the banks. As long as the banks keep lending, people are going to be able to pay more and more for these properties. But again, they're incurring massive amounts of debt with very, very challenging balance sheets, where the point whereas if the interest rate, say in $1 million house, went up, if you pay 1% more $1 million, how much is that more in interest? What's 1% of $1 million? 1% of $1 million is, Pip, you're supposed to be with me here. 1% of $1 million is
$10,000.
There you go. So you take $10,000 and you divide it by 12. Pip, what's 10,000 divided by 12? I gotta keep you in the.
Can't do that one in my head. 833.
So 833 would be your addition to your existing mortgage payment, roughly. You have to pay another $800. So let's say you're paying, $2,500 for a mortgage payment. All of a sudden, it goes up 1%. Your mortgage now is no longer $2,500. It's $3,300, right? It's not realistic. It's not achievable. Nobody saves an extra $800, for their mortgages, because people go, they get qualified, and they always qualify them for the max. This is the max. And when realtors take people out, they're like, what do you qualify for? I'm qualified for a $500,000 house. Okay, great. Let's look at some houses in the, 400, 450 range, but they know that if you get into a house that's even 450,000, that you're prepared to go to 500,000, which you do. I really want this house. So all bidding war, if you're going to lose this house if you don't put in a higher offer, we'll go all the way up to 500,000. So now they have this $500,000 property, which 3 days ago was listed for 450,000. So already 50,000 in the hole, right? To recover over time. And they're paying more for it. And their mortgage is okay because they can afford it because it's been stretched out and interest rates are low. But when and how are interest rates ever going to come back? How are they going to be able to do that if they let this prolong itself over a long period of time? So what does this mean for us? It means we're probably going to continue to see real estate go up. We're probably going to continue to see the market go up. This is going to be it. But there has to be a day, unless it actually works, where it's so long that all of a sudden, incomes and asset prices come to the balance where it makes sense, this whole transition. But this is going to take a long time for the economy to shift into this new phase. At least in my belief, it's going to take a long time. So what does this all tell us? What's the lesson to be learned here? Is this: prices aren't real. None of those prices of those property, like we were talking about this yesterday, this idea that there's a boom in real estate, that real estate is, oh wow, there's just this short supply. This is silliness. This is not a supply problem. This is interest rates have dropped. People are paying more because they can afford to pay more, and they think, why not, right? I've been allowed, where I could only, qualify for $1,500 a month. Now I can qualify for $2,000 a month, right? Because why? Interest rates have gone down. Interest rates have gone down. So it's almost like I'm making more money, but I'm not. I'm still making only that $1,500. But if interest rates go down, what I needed $2,000 for, I only need $1,500 for. So people are gonna balloon debt into hard assets and into equities, right? Balloon their debt huge, and it's gonna come to a point where you can't expect people's incomes to go up to continue to watch prices go up in real estate and the stock market. It's not realistic. It's not real. There's got to be a point where, if incomes don't match the housing prices, they got to come down, right? So whenever that happens, I don't know. I don't know when that's going to happen. Maybe this will work for the Fed. Maybe over the next decade, they actually do meet their targets and things happen and they're trying to ease the pain. I get it. But for us individuals understanding wealth, you got to know that house that was, 500,000, 6 months ago, and it's 550. You got to know that's fake. You got to know that's not real. Nothing changed with that house. Literally nothing changed with that house. So this idea that, you can just buy property and you're going to get rich is a short term, in the span of a lifetime. It's a short term proposition. It's a short term. That being said, hey, prices are going to continue to go up. I mean, if they're committed to keep, interest rates low, highs is going to, unemployment's going to go down. Why? Because when everybody gets out again and they got all this helicopter money, which is helicopter money is money. Basically, this is what the Fed did. They flew a helicopter over cities and started throwing money out with these paychecks. Like, why did you just sign a bill to, keep throwing money, right? Keep throwing money out to people, straight to the consumer, and let the consumer consume. And what's the consumer doing? How can people not be working and producing an income if prices continue to go up in real estate stock? It's hilarious to me. but it's real, because it states the fact that money supply, it's all about money supply, and that you cannot trap wealth. You can't trap wealth. These assets values are not real. Don't be seduced by it, but it doesn't mean you can't take advantage of it, right? You can buy property, sell it, and make the capital gains. But if you buy property now, and you're intending to hold it on a long term, this to me is very high risk, very, very high risk. Because if interest rates go up a half point or a point or 2, like over time, if interest rates go back and they rebound, which they want, by the way, they want the interest rates to come back, right? So if interest rates come back to even 3.5%, 4%, that house, I mean, if you're either paying interest or you're paying principal. And if the interest goes up, you can only afford so much principal. So the price of the house goes down. As interest rates go down, you can afford more principal. You end up paying more for the same house, but you're not actually getting more. It's the same exact house. So if you're going to play the game for capital gains, because dividends and cash flow, they're going to be dead for a long time. They're going to be dead. As prices continue to rise, cash flow, the opportunity for cash flow and dividends continues to shrink. And this is a great example of some of these companies like Zoom that are exploding, even Amazon and Apple. These are great companies, right? Certainly, warrant some value, but the yield, like the dividend, come on. I mean, this is what, I don't know. Apple, let's see what Apple pays for a dividend. So I can give you exactly what Apple's going to pay you for their money. So let's look at Apple. Give me 1 second. And is there any questions, Pip, or anything that people are asking?
You just keep talking. I can't ever interrupt you.
Okay, go ahead. I'm going to look up the dividend for.
So one of the questions is, and it comes from Core. So Core always has good questions. He says, Sam says it has nothing to do with supply and demand, but isn't the population growing? I agree the population is growing a little bit. What Sam is saying is prices are going up even if the population isn't growing because interest rates are coming down. You can afford more house for the same amount of money. And that's what I think there may be a bit of a disconnect on some of the thinking. I also agree that if we're looking at, one of the questions was, should I wait and refinance my house or do my home equity line of credit later if we think the market's going to continue to go up? I said no on that, because I would see what you can get right now. That's my personal opinion. Obviously, I could be wrong and the prices could go up for another 2, 3, 4 years. But my opinion is see what you can get right now. And then if the markets don't go up, if they do flatten off, then you've got as much out of it as you possibly can for the time frame that you're in. So unless you have, if you have other comments to make on those, Sam, you're more than welcome to. Obviously.
No, I agree with you. I mean, there's no risk. If you believe real estate prices are going to continue to rise, there's no risk in taking a line of credit now, because you can extend that line of credit as prices go up. You don't need to wait. It's not like, oh, I get this line of credit and I can't stretch it. They're going to want to continue to stretch. I've had a couple of banks approach me already about doing some refinancing, so some equity and stuff, and they wanted. No, first it was, do you want to break your mortgage because interest rates are down? I'm like, nah, yeah, you can run some scenarios. I don't think it's going to do much. They're like, okay, let's run some scenarios. Oh no, it's not a good idea for you to break your mortgage right now because of the penalty interest rate differential or 3 months. I mean, it's not worth it to you. But if you do a line of credit, in addition to that, guess what? We can pay more for the breaking the mortgage, and you can actually get a little more back, and you can pay down some higher interest rate credit or bills that you have some debt, and you can put it against the property, which I imagine is going to come in a large wave, some refinancing large waves, as the debt bloats for people and interest rates are low. It's, people are like, it makes complete sense. Let me go refinance the mortgage or get a line of credit. And refinancing the mortgage is really what they love you to do, right? To continue that wheel going. So refinance the mortgage, and then in Canada, more the US, because in Canada we have 5-year terms pretty much, right? Which means that every 5 years I got to renegotiate my mortgage, which could be extremely dangerous.
Or you could move to the US and not have to worry about that stuff.
Yes, 30-year fixed mortgages, 30-year fixed mortgages. So going back to cores, so I agree with you, Pip, 100%. Absolutely. If you want to get a line of credit, go nuts. I mean, if you're borrowing at, and this is the thing. I mean, I'm not a big fan, of obviously paying off debt, especially low cost debt of property debt. So borrowing your own money, the equity in your house, your own money, to me it doesn't sound appealing, right? So I would consider, and it's up to you, I would consider refinancing the property. So let's say you have a big chunk of equity in your house. Why not refinance it for another 30 years, and pull that equity out, actual cash, and have your interest fixed at, say, 2.5. Now you have the cash, it's fixed at 2.5, and it can't go higher for 30 years, right? That's the only interest that you're paying is the 2.5. If you do the line of credit, it floats, right? Line of credits float based on interest rates. So it might be beneficial to consider to take that money, fix it at 2.5, and then go put it somewhere, hopefully in capital gains opportunities, right? Buying and selling to increase the return beyond the 2.5% cost. You also said, Core, that the population is growing. Um, really, the trend is not so, right? I mean, obviously the population is growing, but if you look at advanced economies like the United States, Canada, UK, Germany, places, that's not everybody, by the way. I'm not excluding anybody. It's pretty much flat, right? We're not having more babies. Now, Pip has mentioned this is absolutely true, and these are emerging economies like India, and Pakistan. That Asian area is still huge population, but as they advance, their population is going to flatten out. That's the trend. The more money we make, the less kids we end up having, right? And it's not because necessarily we're making more money. It's because we have other stuff to do, right? So we're working, we're going to work, we're busy, and we come home, we're tired. so there's less babies. These are just some of the reasons. There's less babies. There's less babies because we're occupied doing other stuff. We're just not bored. So, I mean that in the best possible way. If it's possible to be in the best possible way, but people, you have double income households, right? That the life partners, both of them are working. At the same, they're working, so it's harder to match up your schedules. But anyways, there's always date night. Anyways.
While you're laughing at yourself, there you go.
So the population growth is, unfortunately, as we make more money because we got to work, right? Everybody starts working. There's less time for doing the other stuff.
Well, as you're finalizing your laugh at yourself there, my friend, and I'm just looking up US right now, and I'm just Googling stuff. And so this is a macro trends website, and it's basically saying from 20 to 19 or to 20 from 2019 to 2020. We don't have this stuff for 2021 yet. From 2019 to 2020, the US population increase, decrease, whatever, people dying, people immigrating, all that stuff.
Yeah.
The net was 0.59%, so not even 1%. Now, in some places, you're going to see high influxes because people move. You got some areas where they're coming out, they're leaving from, and some areas where they're moving to. So, but you have a very.
I gotta say this. So when COVID started, they started talking about lockdowns. I'm like, hey, we could have a population boom, right? We could, right? Because everyone's at home, nobody's working, right? Like I was just talking about, everyone's too busy to working. But the problem was the kids were home too. It's not like you were home by yourself and your kids were at school. The kids were there too, so it really did get the impact. I didn't think it all the way through. But anyways.
Kind of like Thanksgiving because all the coats are on the bed, right? Did I just say that out loud? I didn't I?
So population growth declines. It declines, and as we become more and more wealthy, and because we are working. So anyways, so there isn't. I would, you look at it, Core. Do we really need, 14 developments in our city, developing neighborhood 30? Where are these babies that have grown up and buying these houses? And who's buying the house? Who's living in the house that I just sold to live in this new neighborhood? Like, who's living in that house, right? It's not like they add to the inventory and the house disappears, that somebody buys a house and the house they lived in disappears. That house is still there. So how does it work where they just keep building houses and the population is not doesn't need all these houses, right? It's unreal. So because houses themselves, they're not built necessarily as well or the way they were built, and not that there was not in perfection. My house is like pretty close to 100 years old. It's still standing 100 years. So how many people or generations? We're talking like 4 generations in this one house. Four generations. So how many houses can they keep building? I have one son. I'm blessed to have that one son, and I'll say it. I don't care. My one regret in life is I didn't have more babies, but I only have one. The kid can buy one house, or maybe 2 if he gets married or divorced. He give me the impact. He give me the impact of 2 houses maximum. All right. I mean, that's the other thing. That's the other thing. You gotta have, if most people still get married. Most people still get married. So Corey, you have a daughter and I have a son, and they get together and they're only buying one house. They're only buying one house if they stay together. They're only buying one house. So it's not like, everybody who has a baby, we have to account for a house. You got to slice that, you got to slice it in half. Sure, there's divorce and everything like that, but people are still getting married, even when they second marriages and third marriages. People live together. That's the way we are. So I don't know if we can explain that growth or that demand by increased population in places like the United States, just advanced economies, right? And I hate even using that word advanced. Like, what does that mean? We're advanced. I mean, it's just our economy's in a different place. So, in emerging economies, same thing, same trend. It's going down. Same trend. Pip, what else we got?
That's about all the questions right now. More demand for locks on the doors in the bedrooms when the kids are home, I think, is one of the comments that I got up here. I'm not sure how we got on that topic, but I look for there actually to be a bit of a decrease in the population for 2020. I don't know that to be a fact.
No, it makes sense.
You got a few more deaths, maybe, but I'm going to guess. Now, obviously, and I'm not trying to be political here. We have more COVID deaths, but I'll bet we have less deaths on the road because not as many people have been out driving. Yes. I mean, there's got to be certain
even flu season, way down.
Flu season was almost non-existent this year.
Yeah, because everybody was.
And so, I mean, there's going to be some things where you're not going to have as many deaths because of our behaviors from this last year, but obviously COVID deaths, however you want to count those are going to be up that we didn't have the time before or the year before. But either way, I just think the fact that, and Sam, it's funny, but it's truly not a joke with, even though people are home more, they're worried about the future. They're worried about the money. They're worried about their jobs.
Sure.
They're not going to, and I'm not saying any better than this, reproduce as much.
Right.
I mean, at least that's what my thought process is. I don't know that you're going to see any population. I'm guessing in the U.S. I didn't look up what Canada was. I can do that. I'm guessing the U.S. will be fairly flat in 2020.
Yeah, and this impact of the way things are going and with COVID and the job future, it's difficult to say what it's going to look like on the other side, or if there's another side, or there's a remnants or a trail of this new environment for a long time. Maybe this is the way we manage. Maybe COVID and other things like COVID continue to last and plague us, because that's what it is in some form over time. So it's difficult to say what we're going to look like. Yeah, Pip, what's our?
I'm just going to tell you that actually Canadian population increase from 19 to 20 was U.S. was 0.59. I think I said. This is 0.89 in Canada. So they actually had a bigger percentage increase, so almost a 1% increase in Canada.
You know what I think, and I'm not going to say for sure, but I would say that's immigration. Your immigration dropped during the Trump years. And Canada's, we opened our borders, right? I mean, we did. And I think a lot of that is immigration and growth. So which is great. I mean, who's really not an immigrant? This is an interesting, maybe philosophical question, not for now. But the point being is that for you and your money, this is where, coming back to it, I mean, the laws of wealth are real. It doesn't matter what they do. These things will never go away. They're the laws of wealth. And when you try to manipulate those laws, you get into trouble. It's trying to, it's thinking, well, I can fall down and it won't hurt because gravity only is sometimes, right? It only, gravity only works sometimes. So I'm not afraid of falling. Unfortunately, it doesn't matter. You'll always fall to the ground, and it'll depending on the height, of course, it's gonna hurt. So it's not to say don't fall, but don't pretend that you can fall over and over and over again, and you're going to get away with something. Gravity's real. These laws are real. These laws are real. All wealth is created. Clearly, the Fed showed us that all wealth is created. These houses are not worth more. That's crazy. Like in a sense of real value. Obviously, the market's deciding supply and demand determines the value of all things. Law number 3, right? So sure, prices are going up, but why? Why would the prices go up? Like why? They don't produce more income if I rent them out. They don't produce more income relative to that increase in value, right? So why is it going up? The roof isn't new. It's the same roof, same paint, same everything, you know. Why are these values going up? So this idea that, you know, this boom is, it's just, and it's not even driven by jobs, or it's not driven by economy growth or GDP. This is very dangerous. It's very dangerous. But when you got the, you know, the mammoth Fed, you know, continuing to be committed to this, you know, and hoping that over time, I mean, they're going to have to do this for a long time. This is why, you know, interest rates, I mean, they're you know, short-term interest rates are like 0.5. What do you go from 0? Like, you know what I mean? Are we going to turn into Europe where we have negative interest rates and you get punished for saving money? That's the only way we're going to get people to spend money, is punish them. Like, if you don't spend this money and you want to save it, well, you're going to get, we're going to tax you for that. It's unbelievable. It's unbelievable. And I don't, you know, this deficit, I don't know where your deficit is now, Pip, but it's, and not that Canada's is doing any better during COVID. We're inflating our deficits, and I'm not afraid at all of deficit sizes. That doesn't bother me. The size of the deficit doesn't bother me. Who's managing the deficit? that makes me nervous, right? But I mean, debt itself is fine if you can manage the debt. And just remember, the one offshoot benefit to this interest rate drop. Who's benefiting from this, by the way? Who's benefiting from this? So as interest rates go down, who benefits from interest rates going down? So you're in the United States, I think of a world stage, interest rates go down. What does that mean to a country like that has a great deal of debt? You know, with the United States has a great deal of debt. So a country like China, what does that mean to China? What does that mean to China? If interest rates go down, what does that mean for China? What does that mean for China? So China bought debt from the US, say 3 years ago, 4 years ago. And the interest rate on that debt was, say, 3.5%. And now the interest rate has gone down. So the bonds that the China owns now are great, right? Because they're getting 3.5% on these long-term bonds. Say, and I'm just making up these numbers. Just know that the borrowing was higher here than it is here. So the money that they have now is worth more because the interest rates have dropped. And this is the complaint that countries that have large amounts of debt with the United States, because it's still the reserve currency of the world. And we can get into the history of why that happened. But anyways, as interest rates go up, as the United States creates inflation, which is not happening right now, the debt that they have is actually worth less, right? Because the buying power is less, right? Because it's inflation, right? That it's not as worth as much. And countries always hated that. The United States can I mean, just does that whenever they want. But that's what you get when you're the largest largest economy in the world. You get to do that, and you're the reserve currency. And there's a reason they're a reserve currency. One of the biggest reasons, and we don't know how long it's going to last, is you still buy a barrel of oil in US dollars. You know, now think about that. US dollars, a barrel of oil is listed in US dollars. That's the cost it's listed at. Now, if you're a buyer of oil and you're not in the United States, you're going to want to use US dollars. You're not going to want to convert your currency, you know, into US and then buy this oil, because there's a cost to it, and there's a fluctuation. All of a sudden that oil could cost you more because your currency is weakened, right, against the US dollar. So what countries do is they have reserves, and the Fed has reserves of other currencies too, right? So when you have trade deficits and you're trading with countries, you want to pay and get paid in your own money. You want to get paid. So the US dollar is still reserve currency, because oil is still listed as US dollars. So people are they need US dollars to buy this oil on the world market, because they don't want to lose value on that. So the U.S. has a huge distinct advantage over other countries around the world, deservedly, I believe, because they're the largest economy in the world, and their consumption levels is the real big commodity that the U.S. has. But the point being is these interest rate changes, what the Fed's doing does affect the world, right? It's a global community. It does have an effect. So people that hold U.S. debt, this going down is good for the bonds that they have or the debt they have, but it's a problem because if the United States isn't spending as much because they're buying the goods from China, this could create a new problem for China, right? That their GDP starts to suffer because the consumption level or what they can afford is less. So, and that's going to spill over into jobs and other stuff. I think there's a whole wave of low-cost jobs coming in the United States and Canada. Low-cost, like low-income jobs. This is what I'm talking. I don't know. I mean, the Feds and the Bank of Canada. I mean, and this is the modern economies. What are you going to do? Like these new jobs that are coming are going to be low-income jobs. They're going to be low-income jobs. That's what's going to happen. And how are you going to adjust all these asset prices to match up to these new incomes? They're not going to be high-income jobs. They're going to be low-income jobs because the jobs that are going to be high-income are going to be specialized and highly skilled in this new economy. The economy, the way the economy is going. So I don't know how they're going to maintain this. Or how long it's going to take, or how long they're committed to it. But this looks like a long-term play by the United States, as an example, to continue to inflow cash. I don't know how long it's going to take, but asset prices should keep going up, I guess, is the lesson. Seek out capital gains because cash flow, it's dividends. I mean, so go ahead, Pip. You're going to say something?
Well, I'm just going to say that last week when we were on here, my wife told me we were well over an hour and 10 minutes. And we said we're going to do 45 minutes for our wealth debate. So we got a couple questions.
Okay.
Core wants to know why you think rent rates went up so drastically as well.
Why rent rates went up so drastically?
Yeah. That's his question.
Like what? What does that mean, drastically?
Well, it's going to take a while to go back and forth with that. So he's saying he thinks rents are going up as well as prices of property. You have I'm sure you have a thought on that.
Relative. So why do you think? Well, I won't get into that because you're right. I'll go back and forth. Okay, look, rents are going to go up. Are going to go up too, right? In this infusion of cash. But really, let's not forget that for a period, and I don't even know if that's still going on in the U.S. You couldn't evict somebody. Someone doesn't have to pay the rent. They couldn't evict it. They couldn't evict you, right? So I don't know how much more those rents are going up, but relative to the increase in price of houses, no way, no chance. And one of the things that creates an increase in rent, right? And these are slight. The big push in rent increase is inflation. The difference in rent, it has less to do with the increase, which is driven mostly by inflation, has to do with house prices. When house prices are high, your quality of renter is better because they can't afford to buy a house. People that could afford to buy a house can't afford to buy a house now, so they become your renter. So they're better quality renter. As prices go down, houses can be bought at a lower cost, your quality of renter actually goes down, right? Because now these people that were renting from you can now afford to buy their house. But think about it: if the person paying the rent is bringing in enough money to cover all the bills and produce cash flow, why wouldn't they buy the house? Like, why wouldn't they buy the house? Think about it. If they could buy the house for $1,000 all in, why would they pay $1,500? The market doesn't allow that to happen. So the market comes in and pushes the price up, and you got a negative yield. It's a negative yield on rents. You're not making money. I don't know where you are, Cora. Where's Cora?
By Woodstock, I think.
Is it Woodstock? Woodstock's actually, not too bad. I don't want to speak like I know Woodstock that well to speak too highly. But think about it. You're not making cash flow from a property in Toronto or Hamilton. Forget it. Not in the metropolitan area. Forget it. Kitchener, Cambridge. Come on. Guelph. These places, I mean, you can't make money. You're bleeding money. You're bleeding money in these places. So yeah, there's probably upward pressure. This has more to do with inflation. This has more to do with inflation. That's where rents go up. It's just the quality of renter, right?
So Core wants to have a meeting with you. So I think that's good for you guys. You guys should have a meeting
Sure.
and talk it out. You should.
Okay.
And so with that being said, Sam, you have any parting thoughts for the night?
So here the yield, the price per earnings is so you get $3.70 for an investment of $125 from Apple. That's what you get. So that's what you get. So your yield is, I don't know exactly what that comes out to. Pip, what does it come out to? I think it comes out to $3.70. Can you divide that? Here, I'll do it.
Yeah, I'm not quite sure where your numbers are coming from. Sorry.
$3. What I say? $3.70 divided by 125. So it's about 2.9%. 2.9. Say call it 3%. So a company like Apple, which actually is pretty good for the stock market, for Apple, you're making about 3% for your investment. That's from a great company like Apple. In Amazon, I'm guessing it's less than that if you do price to earnings. Forget about Tesla and Zoom. I mean, you're making nothing off these companies. So very little. So Zoom, nothing, because they don't make any money. But anyways, the point being is, as prices go up, those yields are going to go down, right? And you're going to make less and less on those yields. So dividends and cash flow are going to be a bigger challenge in this direction that the Fed's going and the economy's going. There's going to be some great opportunities in capital gains. Ultimately, this is the message that I want to. Your money, and Pip talks about velocity of money all the time. Your money needs to move. So thinking about how I can maybe leverage some investment properties, take the equity out, refinance, extend my mortgage, all those things to get your money loose again so you can start investing it, I think is a wonderful, mindset to be in, to see if you can produce more. And I'm not directly talking to anybody. I'm just saying, for me, borrow. I mean, they're giving the money away for free, except make sure you have a place to put that money. Make sure you have a place that you can produce, but borrow. It's just a wonderful time to be a borrower. That's it.
Awesome. So a couple of things, guys. Share this with people if you would, please. We greatly appreciate that. You can watch it on YouTube. Go to my YouTube channel and you can view it on their site. Some people sign up for that today. I saw that come through on an email. So please do that. Also, Monday night, we have a creative financing class that we're going to be doing. If you don't know how to get on that, you can go ahead and send me a private message and get on the link for that. It's a free 90-minute class on creative financing. And so Steve's going to be leading that. I'll be there as well. I'm sure Sam will be on the chat box as well with me. So that's Monday at 8:00 Eastern. So from now until then, we will see you on Monday, or we'll see you on Wednesday. Sam?
Send your stories for news articles. If you have any news stories that you want us to talk about, if you see some ridiculous things about money and finance, please let us know. And I feel like tonight was a little too educational. I think we needed to.
You were calm, Sam. It's all good.
I know. My apologies for my my demeanor tonight. I got about 4 hours sleep last night. So
awesome.
We'll talk next time, and I'll be more I think unbridled enthusiasm.
Everybody, you guys have a good night, a good week. Turn to somebody you know, somebody you don't know, and say you're going to be all right. Talk to you guys.
It's going to be all right. Don't worry. Eventually the kids will go back to school.